welcome to Quilter Cheviot's Markets Uncut podcast, your weekly insight into the topics and trends that we've been exploring for you here at Quilter Cheviot. Remember, so you don't miss future episodes, to be sure to hit the follow button on whichever streaming platform you are listening on, or by following hashtag QC, a weekly comment on LinkedIn. I'm your host, Fraser Wilkinson, investment manager here in our Leeds office. And this week, I am pleased to be joined by Maurizio Carulli, our head of commodities equity research. Good morning, Maurizio.
Good morning.
Well, there's a lot going on in your sector at the moment in the news. Mining companies have hit the headlines last week with Rio Tinto proposing to take over Glencore. Could you talk us through how important this is for the UK stock market? And will it be positive for the value of both companies?
Thank you, Fraser. The mining sector represents about 7% of the UK stock market index. So, whatever happens in the sector, it is certainly important for the stock market as a whole. Companies in the mining sector have historically grown both organically and via acquisition of other companies. BHP bought Billiton 25 years ago, Rio Tinto bought Alcan 20 years ago, and Glencore bought Strata 10 years ago. A new wave of M&A is currently occurring among UK-listed mining companies. In September, Anglo American announced a merger with Canadian miner Teck Resources. And past Friday, as you mentioned, Rio Tinto and Glencore announced that they are in talks for a possible merger. M&A deals can both create or destroy shareholder value, depending on the merger terms, future synergies, cost savings, and all sorts of other considerations. The merger between Anglo American and Teck Resources is sound and expected to create value. The combination of Rio Tinto and Glencore is still not defined, and therefore it is a bit early to express a definitive judgment if it will create shareholder value or not. But given that it is Rio Tinto who is pursuing Glencore, it is likely that the merger terms will include a premium paid for Glencore shares, which will be obviously benefit Glencore shareholders. For Rio Tinto, it will depend on how much synergies and additional growth will justify the premium likely paid. The mining sector has recently outperformed the general UK stock market index, and because of this new M&A wave, and it is possible that such strength will continue.
That's fantastic, Maurizio. I know as investment managers, we always enjoy takeovers going on. It's lovely to see companies where you have maybe put out long-term targets for what share price it might reach, and then it reaches that price very quickly when somebody takes over. So a little bit of activity is always good. And obviously, with the commodity market being so strong at the moment and the dollar a little bit weak, we've seen some good returns in commodity-related sectors recently. Focusing on commodities and not least President Trump's designs on Venezuelan oil and even Greenland's minerals, how do the commodity companies that you research negotiate this fraught geopolitical tensions? Nationalization and confiscation of private assets, it can be a risk for us as private owners of companies and assets and shares that could be taken over by foreign governments. And I guess additionally, a lot of the operations can be in dangerous or tense regions of the world. Would you say investors receive a higher return to compensate for these risks in commodity companies?
Great question, Fraser. Commodities companies are often obliged to operate in remote and often politically unstable regions because it is where the resources are extracted, being them oil or copper or coal. So companies are used to geopolitical uncertainty and are usually well equipped to cope with that. Furthermore, host countries often depend for their fiscal revenues on foreign operators to provide investments and technical skills. So, at least in theory, there should be an alignment of interest between local governments and foreign mining companies. And however, you have very rightly reminded our audience that nationalizations, expropriations, and outright seizure of assets do happen. But on balance, resources companies are able to compensate these one-off losses over time thanks to the double-digit annual return on capital invested the resources activities enjoy.
Absolutely. Well, it's good to see. You know, we do take risks in investing, calculated risks, and it's good to see it when it pays off. I've been thinking about oil prices as well. Oil prices have been extremely volatile over the last 20 years and been over $100 a barrel as recently as three and a half years ago. But ultimately, we're broadly back today to where oil prices started 20 years ago. And there's been a huge amount of inflation over the last 20 years. If you think of food prices, house prices, even gold prices. Can you explain why prices of oil have not matched inflation? And what's the outlook for oil and energy prices generally? Does Russia, Venezuela, and Iran have much bearing these days on the price? So I guess the ultimate question is would you rate oil companies as a buy in this increasingly environmentally aware world?
Good, but rather difficult questions, Fraser. I'm not going to thank you for it. Jokes apart, let me try to untangle them one by one. Oil price influence inflation indexes, as everyone notices when oil price rises and petrol prices increase at the pump as a consequence. But the opposite is not necessarily true. The reason why oil prices do not necessarily match inflation is because OPEC countries have a very low cost of production and because there are lots of oil available reserves. Also, cost of production itself is more linked to the oil cycle rather than to the general inflation cycle. Technological advances help to further compress production and development costs. So, oil prices tend to rise only in periods when OPEC artificially restrict production or when demand for oil is particularly strong. The outlook for oil prices in 2026 is softish due to planned increases in OPEC oil production, but current political tensions in Venezuela and in Iran are having a short-term effect of keeping oil prices above $60 per barrel. The need to combat climate change and to lower CO2 emissions has seen a lot of scrutiny of oil companies by environmental groups, institutional investors, and the general public. Demand for energy is steadily increasing, and oil and gas will continue to be an important part of that demand for decades to come. Renewable energy is progressively increasing, but hydrocarbons will continue to have a significant role in the energy mix and, as a consequence, in the stock market.
Yes, it often surprises me that people forget that oil produces a lot of products that are essential, even if we want to reduce the amount of energy that we burn from fossil fuels, plastics, even tarmac, bitumen, and things like that. So it's going to be very hard to completely eliminate oil from our day-to-day lives. Well, I guess without a huge amount of change. So my final question is just broadly about inflation and interest rates. They do have a huge bearing on our investment portfolios. If inflation is high, then investment returns can feel less attractive because it's a relative measure. But also if inflation is high, interest rates can go up. And when interest rates are high, obviously cash becomes a more enticing option, and not investing in long-term assets. So we generally like low inflation and low interest rates. So I guess the flip side to that is if inflation is high, then companies can sometimes charge more for their products and make a bit more profit for us. But it is a fundamental question for our investment portfolios, and interest rates are led by what happens in the inflation world. So I've got to ask our commodity analyst, Maurizio, what are the prospects for commodity prices over the coming year?
Okay, I have already mentioned about oil. Among other commodities, copper is likely to continue to experience price strength due to severe disruption in supply, which is currently occurring, as well as an increasing level of demand thanks to the energy transition, AI, etc., etc. We're also currently experiencing some positive conditions in aluminium, albeit this might change toward the end of the year. Iron ore will probably remain stable. And I will be probably stopping here.
Great. Well, fingers crossed. I could do with a few less price rises in my Tesco shop, I must say. Other supermarkets are available. Well, thank you, Maurizio, for those great insights, and to all of you for listening. Did you enjoy our discussion on the podcast today? We do love to hear from our listeners, so please review the show now wherever you're listening and share it on your socials and tag us at Quilter Cheviot. To make sure you don't miss a future episode, tap the subscribe button, and we will be back next week. In the meantime, head over to our website, www.quiltercheviot.com, where you can read the accompanying market overview, as well as subscribe to our weekly comment newsletter. You can also stay up to date with our thoughts on market news, industry insights, and our upcoming events and webinars on our website or our social media pages. And finally, do you have any questions that you'd like to ask one of our experts for our next podcast? Simply ask them via the weekly comments page on our website. We do love to hear your questions. That's it for today. So thank you, Maurizio, for your time today, and all of you for listening. See you next time.
This podcast is marketing material, not investment advice or research material. Investments can go up as well as down, and past performance isn't a guide to the future.